Hello guys, glad to have you on board again today. Just like I said yesterday, we're going to change just a few things about the way we get ahead of those daily shows, and when we're going to take care of intraday, I really want to put a deep separation between swings and intradays and try to avoid doing what I've done for the latest weeks, which was kind of making a swing introduction before getting into potentially intraday scenarios. As normally, and I thought I had made it clear, but apparently I didn't, and I really had some of you guys confused about that, and I'm sorry once again. I shouldn't even do those stuff and put them together. So I shouldn't even talk about swing trades when we do intradays, because you should absolutely not put them together. If you're a swing trader, you take care of the swing trades, and therefore you have to have a context, a macroeconomic context that you take in consideration when your decision-making process starts to put in place. But on the intraday, all of this, you don't give a shit about that. The only thing you take care of is having a look at the goddamn calendar and making sure that you don't have big upcoming catalyst before putting a trade. So today, the only thing we'll have is this: the job openings at 4 p.m. So it's definitely not that big of a deal, and most likely it isn't going to trigger 5 minutes from now. So we don't even give a shit about that, all right? But you need to do this job, making sure that there is no upcoming catalyst right before taking a trade. So in here, no problems. The next catalyst is 5 hours from now, so we can trade, obviously, anything that is shown in front of us. So the intraday is this: you forget about every fucking thing that you might be listening to into the swing scenarios, and you just focus on what you have in front of you at short term. You play all by technicals, all right? Playing intraday is more technical than trading swing trades, in which you might need to assess psychological structures and everything like that. So it's easier to do intraday, but that doesn't mean it isn't riskier as well. All right, easier always means riskier as well. So there are other risks on the intraday, like forgetting about a catalyst, and obviously those catalysts can absolutely fuck up every technicals you have in place. Even though you have some strong bearish or bullish signals, just a catalyst on the day can change it all, and you have absolutely no control about that. So this is where the intraday risk stands. The fact that those catalysts, you don't have the number, and sometimes they will just do nothing. Sometimes they will push the price to your validation and they'll go according to your plans. That would be great. Sometimes they're just gonna fuck it up, which means no matter how great your selling signals or buying signals will be, you'll just apply the strategy and the catalyst will just destroy it all. That's how it goes, all right? This is where the high level of risk stands on the intraday trades. But obviously, you don't have to take care of the psychological structures and all those stuff that we absolutely need to take care of in the swing trades. But the thing is that in a swing trade, we don't give a shit about catalysts, because those catalysts, daily to weekly scenarios, normally they should be dampened, and what we care about is the shape of those catalysts, like the direction and the trends they have. Are the CPI rising in a fourth quarter trend, or are they dampening and everything like that? All right. So anyway, that aside, let it go with the swing trades. It was just a quick introduction in here. So we're going to take care of technicals. I'm going to give you a very simple way of doing this. Obviously in here, I'm going to use the advantage of my pro account in TradingView. I'm going to do this multi-charts, but that doesn't mean you have to do it as well, all right? Some of you guys have free versions of TradingView, and I stand on this. This is more than necessary. You don't need to have pro versions of TradingView. It isn't required. The thing is that this is a convenience that I'm going to use because I have access to this. If you don't, then no problem, all right? The thing is that having 8 charts one next to each other is easier, but you can just do this same job with this. I mean, if you're just an intraday trader, why the fuck would you need to have all this shit? So you need to have the 8 or there is less than 10 assets you can trade on an intraday basis. You've got the major forex, your dollar, USD, GPY, but in order to trade intraday, you need to trade something that is highly fucking liquid. So you need to have liquidity, and therefore I suggest these 8 assets are a pretty good start. if you want to trade intraday. So take those 8s. All the rest you don't give a shit. Do you even have a look at the BUNDs to trade on an intraday? No, you don't. Do you need to understand how the BUNDs move for the correlation purposes? Obviously you don't give a shit. It's intraday. So intraday is just about technicals, and you're just going to do this. So take those 8 things, all right? And if you just have one chart available, then you're just going to scroll through them. I'm give you the tip, all right? If you put them on the list in here, all right? All right, you can hide the list and press press space. When you're pressing the space button, it switches to the next one in the list. All right, so you can do this. You open your goddamn charts, you put it in full screen, and you just press escape, and it's just gonna roll over one to the next, so you're easily gonna understand and visualize which one is the most interesting. And you don't even need to have that goddamn A chart set up or everything like that. All right, I'm gonna do it because it's more convenient, but once again, absolutely not necessary for you guys. So this is what we have, and this is the strategy you're going to put in place. So the thing is that on an intraday basis, this is all about technical. So what you're going to do is trying to figure out who's the most interesting for speculation today. Tomorrow is going to be another day, and the context will be different tomorrow. So you need to zoom out quite a bit. All right. In here, once again, I'm going to delete the prices. I know some of you guys doesn't really like that, but I mean, at some point, I have to make some choices. And I think that no matter what you think, this is for the best. Deleting the prices really erases all the noise and gives you much clearer sight of what the actual context is. So I'm going to do it in that kind of context. So what you need to understand is that finding the good one in an intraday basis generally is done by erasing the bad ones. All right. So you have multiple options. Basically, you can trade all those assets. So all we're going to do is putting odds in a favor by erasing those who have far less profitable odds to trade. So the first way you're going to do this, I suggest you put in place the extreme channel. Remember, this is an option that is deactivated by default. You turn it on, all right, and you'll have those 2 lines. If my memory is right, they're grayed out by default, and you can color them red and blue or keep them gray. The thing is that you're going to search for the assets that are trading close to the red or the blue area, because all that's says, remember, this is the context channel of the higher time frame. So we're 15 minutes in here, which means this is the 1 hour chart context that you see there. So trading in there means that, obviously, remember how you do this stuff. All right, let me take this. Let's take the FTSE's example, or take this one. All right, I'm going to take the Euro stocks. So the way you read this thing, all right, what this thing means is that this is the area which prices will most likely be 99% of time, or 90% of time. Then at some point, prices may cross out this area, all right, which just means we're trading into the 1 hour resistance context or into the 1 hour support context. So remember that the rules are the extreme channels, you never even fucking buy on top of this line. So it's forgotten, sorry. Oh my God. It's forgotten to trade on top of this area with bullish trades. It's forgotten to sell in here below that line. So as we said, as an opposition, all right, if you're forgotten to sell in here, which means this is interesting to buy. That's how we do. It's interesting to buy because it's freaking stupid to sell in here. All right, so this is the very interesting buying area, very interesting selling area, and gray area. Okay, consider this as it is absolutely white. It's granted to buy in here. It's absolutely black in here. Forgotten to sell, to buy, oh my God. Forgotten to buy in here. So this is black area, white, black, and gray area, shaded grays. Okay, this is where you're going to be most of the time. So obviously, if your goal is to either buy or sell, it's going to be more interesting to sell as close as the red area in a gray shaded area perspective, and buying in this area is obviously more interesting. Consider this as a thermometer. All right, this is where you've got all your shit. All right, so you've got all your graduations in here. So obviously, the lower, the more interesting it is to buy. All right. When you're 50% of your thermometer, it is absolutely 50, gang. So you don't do anything in here. You don't trade that kind of price. So what you're looking at is assets that trade as close to, but possibly not on top of those areas. All right. So now that we've done that, let's apply the rules. So obviously, EUROSTOXX is going to be interesting. DAX is close to, but not as close as the EUROSTOXX. So choosing between those two, which one are you going to take? Obviously, this one. This one is closer to the red area, so it's more interesting because it gives better risk-reward ratio. Okay? The support is 3% lower, and the resistance is 35% higher. In here, the resistance is 0.67% higher, and the support context is 3.5. So for the same distance to support, in here, the resistance is twice higher. All right. In the FTSE, we're trading the red area, which means in here, it's absolutely not possible to buy. It's only selling signals in here. And you'll see that clearly, okay? Those three assets are trading the same way, all right? It's just this one is intermediate, this one is crazy bullish, this one is kind of starting to dampen, all right? So in a selling perspective, this one is lower risk, this one is medium risk, this one is high risk. So you want to sell, this one is the most interesting, but also the riskier. It's the one that's going to bring the highest level of gains, but also has the highest level of picking up your stop losses if things start to rise again and keep on rising. All right, so higher risk, medium risk, lower risk. So first things first, if you want to trade one of those assets, you trade just one. You cannot trade two of those assets. They have the exact same thing. You can see that bullish trend, bullish trend, bullish trend. So what you do in here is that you're going to target retracements and no more than that. You're going to assess that this trend is mature, and what you're going to do is trading against this trend, trading counter trend, so you're going to target retracements. No more than that. So you figured out the context. Those three assets are end of bullish trend, late stage trends that you can trade counter trend to target retracements. Pure and simply, you pick one of those three because it depends on your aggressivity. If you are a very aggressive trader, you're going to pick the FTSE. It's definitely the most interesting. If you are moderate aggressive, then normally you're going to pick up EUROSTOXX. If you're less aggressive, you're going to pick the DAX, which is the weakest. But obviously, you're going to have a large stop loss to put in place. All right, as we can see in here, the US indices are far less interesting, even though the SPX could be kind of interesting. It's close to the red area. But this one, why don't you trade that? Pure and simply because it doesn't even fit the second rule of the strategy. If you want to sell, you never ever fucking sell in the lower 50% of the trend channel. So selling in here is not possible. You can only sell in there. So if you want to trade the SPX, you wait for prices to get in here first. They get in the top area of the trend channel, because otherwise you don't even fit the strategy. You cannot sell in here. You're not even passing the price filtering. In here you do, it's great. You're trading in the context, in the resistant context, close to the extreme channel, out of a mature trend. You've got everything you need in here to sell. But do you sell just like that? No. Remember the steps of the strategy. First step is to identify what you're going to trade. That's what we've done. Second step, identifying the context of the trade you might be putting in place. In here, we know what we're going to do, a correction of this bullish trend. So we're going to try selling and targeting the different Fibonacci level. First one is going to be 23.6, and we're probably going to target 38.2 afterwards. All right? So about the SPX, that will be probably the exact same thing. In here, we can barely see. Oh, now we can see. This is a mature trend, okay, with 1, 2, 3 with the breakout, 4 pullback, and 5 excessive final excess. So we're at the final excess as well in the SPX. We do have interesting areas, but we're sell at higher prices in here. The targets will be exactly the same. You're going to take the lowest low, which is in here, to the highest high we've got so far. And obviously, if we make a higher high today, you're going to have to adjust. But we're going to target the same old thing, the 23.6 and 38% Fibonacci as well in here. So it's the same, exact same scenario. All right? So you can pick whatever you want, selling the US or selling the Euro area. But I think anyway, this morning, it's all about selling on an intraday basis. These trades can take a couple days. So it's an intraday that may be lasting a little bit longer than that. But normally that shouldn't be a big deal, all right? It's taking the trade. There might be an overnight session to keep this trade to get to the targets, or a couple days to get there, but I think that's where we can do. Obviously, I'm doing this in a 15-minute charts. If you want to have something quicker, something faster in terms of response of your trades, then you can go lower time frames, obviously. This is a scale that you can go up and down too. There's no problem with that. So I would say, as usual, the answer in here today is going to be NASDAQ, in terms of interest, far less interesting than the SPX. So don't trade the NASDAQs. I would say the Dow Jones, same thing here, far less interesting than the SPX in terms of risk reward. So if you trade the US, it's all about the SPX. If you trade the Euro area, it's pretty much the same picture over the three major indexes in here, the DAX, the Eurostoxx, and the FTSE. And you can pick up whichever you want, depending on your aggressivity. It's clearly riskier, moderate, low risk. You know where to put your targets. The final question is where you're going to put your stop losses. So let's say we pick the stocks, the Eurostoxx, as a moderate risk taking, which normally you should have if you were a beginner. So in that perspective, you've got multiple options. But I'm going to give you the simplest one, the easiest one. As in here, you can see we're ranging. So you see the trend channel is pretty much the same size of the context channel. So you can pick the average. All right, oh, God damn it. All right, so you pick the average size, all right, so it's approximately this, all right, and let's say you're going to take this bearish entry in here. Remember that we need to wait for a signal. There is also a step. You cannot trade just this. You're going to wait for a fucking signal. But let's say, all right, you take a trade in here. All right, where are you going to put your stop loss? Minimum stop loss for a moderate is at least the size, the approximate size of the trend channel. So this is where you're going to put the stop losses in here. The minimum stop loss is going to be there. All right, this is the minimum stop loss. Obviously, those who want even less risk will double it. All right, but it's starting to be quite an expensive stop loss. All right, in those two conditions, this one costs 0.5%. This one costs you 1%, and you have to take the same amount of risk. This trade is a range trade, kind of trendy. If you risk more than 1.5% of capital in there, you and I don't agree. So you know the risk is definitely going to be there because this kind of context is kind of trendy. It is not it is a little bit risky. We're just targeting retracement, so it's a 1.5% risk on capital. Maximum. Obviously, you can take 1%. I'm fine with that. The lower the risk, but obviously the lower the gain as well. So 1.5. Put it max risk, so it's going to be clearer. So 1% max risk on capital. So those who take this, all right, let's say you take 1.5% risk, you're going to have leveraged 3, all right, which means you're going to multiply the amplitudes by 3, entering in here, targeting the 23.6 in here, and in here you're going to profit take number 1 if you have a signal, but any fucking way there's a maximum target in there. All right, which means we go there, you don't even think about going any further, you profit take in here. We're intraday trading, we're not swing tradings. Okay, so let's forget this, all right? It's, let's say, 1.86%. That you're going to multiply 3 times, all right? So what you get in here is 5.5 gains, okay? So you would take 1.5 risk, all right, and scenario with a stop loss in here. So first stop loss is going to bring approximately 5.5% gain if you reach out to target maximum without locking on the gains in here. So without intermediate risk management, you're going to have 5.5% gain. If you take the second stop loss instead, in here, sorry, it's going to be 1.5 leverage because the stop losses. You really need to get that. If you don't get it, you really need to review this, all right? The asset stop loss is 1%, and we're going to risk 1.5, which means the leverage is 1.5. You're going to take 1.5 your account size in value of this stock, of this asset. You've got this that can help you calculate this shit. Oh, shit. What the hell's that? I think I can use, yeah, we're going to use a paper trading asset. Normally we should be trading this. Alright, so let's do, god damn it, reset. Let's reset to 10K. This is the average account size for beginners. So let's take this. So let's say we're going to trade with leverage 1.5 in here. So we're going to take, oh, let's take the first trade in here with a stop loss in here. So we know, all right, that we're going to risk 1% capital. So order price. So we're going to limit sell, all right. The entry price is, can we set it? No, we can't. So entry price is, and we said 35.55, so 35.55, all right. The quantity is, oh my god, they had the option before. What the fuck is that? Oh my god, what the hell are they doing? Show quantity in percent and risk. Oh yeah, here it is. God damn it, I'm so sorry. So the stop loss, all right, in here you say the stop loss at 34.80, all right, and in here we said it's going to be 34.73, all right, 73, all right. We defined the price stop loss. We were going to enter at 35.55. We're going to stop loss at 35.73, all right. So now you can adjust all of this. You said you want to risk 1.5. So you're going to set 1.5% risk in here, all right? And it's basically calculating the everything you need in here, all right? So you're going to sell 5 contracts in here, all right? It's been calculated. It says you're going to sell 5 fucking contracts. So let's take the example in here. But before doing anything like that, remember you're not doing this. Remember what you do, all right? This is what you do when you had that goddamn signal, all right? Do you see any fucking signal in here? The only thing we have is this, all right? It's the cross in here. It's a better signal, and once again, these signals are only meant to be traded on trends. Do you see a bearish trend in here? Obviously not. So you don't even consider this as a tradable signal. So you need to wait for a signal to show up in the Euro stocks at the moment. If this signal show up, then you define your entry price and everything like that. All right, but you've calculated it. It's approximately 5 contracts that you're going to have to sell. But you know it right now, all right? So you calculated the approximate size of your trade. It doesn't have to be absolutely precise, but you know that you need to trade 5 contracts in here on a 10K account size. All right? So use this tool. It's really great. You don't have to, you put your account size in here. It's going to help you sizing your position accordingly. And remember how we do. You set the average entry price you think you're going to pay. It's approximately here. You said that your stop loss is approximately going to be this side, so a 30 pip stop loss. And you need to understand that this 30 pip stop loss associated to 1.5% risk and capital lets you trade 5 contracts. Right? So you're going to trade 5 fucking contracts. Each pip is going to cost $5, all right? And the trade value is $17K, all right? We're taking in dollars. So you approximately have this leverage we said earlier, which means you're going to trade more money than you have on your account. You're going to leverage the asset. But that's what we do on intraday. But you're not taking crazy amount of risks, all right? So once again, leverage is a good tool when it's used appropriately. It's absolutely this. You need to do this with appropriate risk management. If you calculated the risk, if you do have a scenario, normally your stop loss shouldn't be reached out to. And if it is, even if you're using leverage, you're still going to lose 1.5%. All right? And that's up to you. Obviously, all of this is subjective and depends on what you want. If you think you don't want 1.5% but just 1% capital, normally, what the hell do they say? Still 5 contracts. Oh man, 1% risk, dollar risk. What the freaking fucking hell? All right, that they've been moving our stop loss in here. So we said the stop loss is 73. What the fuck is that? What the hell have we done? I'm just trying to figure this freaking... Okay, it's been moving. Oh my freaking god! We can't do that. They cannot calculate the size. Oh, that's stupid. All right, so we need to change that. All right, I'm sorry, I thought it was working differently than the things we've done. So you set one of those, oh man, they really need to change that. That's stupid as hell. So it is not 5 contracts in here, definitely not. All right, so let's say 4 contracts with a stop loss at, we said 35.73. 35.73 was that? 70, yeah, 25.73. So in here, as we can see, with 4 units, apparently you're going to have to rise units one by one. So if you take 4 contracts, it's a 0.72% risk. All right. So that's what you do. All right. You don't change the risk in here. That's what. All right. Let's restart all over again. How do you calculate the number of units you're going to have to trade in this fucking asset? And have you seen this? The red triangle is showing up. So red triangle could be a signal to trade. Obviously, there is no signal for now. So I would suggest you cautiously trade that, but that's a signal that might be usable in 5 minutes, which means trading without signal or trading that signal, which is, I mean, we're ranging, so using trending signal, I'm okay. I would say that's viable, but if you do this, you really put the stop loss in here at least, really at least. So anyway, so we said entry price is approximately this, price stop loss is approximately this. Let's say a 20 pip stop loss. All right, so it's 35.75. So it is. All right, what the fuck is that? All right, it's the person from the asset. Oh my God, I got it. All right, it's just updated. So 35.75, 20 pip stop loss. All right, so 3 units represent 0.6% risk. So if you want 1%, all right, in here it's 5 units. If you want 1.5, it's 7 units. All right, that's how you calculated this. I'm sorry, I should have figured it out. All right, so you've got 2 areas to calculate. First, you set in here, and you're going to use the stop loss price in here to be defining, and then you set the level of risk you want, and it's going to calculate the number of units you trade. All right, so let's take the example in here. Let's say, just to show you how this works, all right, for those who are paper trading, which means those who are demo trading, you can use this functionality right into TradingView. It's great. Those who are trading on other platforms, because so far it's still not possible to trade into TradingView, despite you have the, unless you have accounts on the partnerships they have, which is not great for the moment, but hopefully in the future will be. So let's say, okay, we've got the signal, we've got the red triangle, and we're at the candle close. So we're 4 minutes from now, we take this trade. All right, let's do this. So now we're going to switch to market trades. We knew that we're going to sell 7 units. All right, and for now, at the current price, the risk is 1.90. All right, so let's say 6 is more appropriate in here. All right, well, 1.6 risk. All right, let's say, all right, now we have it, the candle is closing, let's sell. All right, see what it looks like. All right, oh, it's paper trading, obviously. All right, but on a 10K account, you would sell 6 contracts of this CFD, and you would just accordingly, all right, the stop loss is set already. Great, cool, well, that's a good feature. So your stop loss is already set. What you're going to do right now is going to set, no, we're not reversing the goddamn position. We're going to set the profit taking. So, as you see, you remember we had a maximum target in here. How do we do that goddamn thing? Protect position. Okay, so the profit taking is, we said, 33.90. 33.90 pips. All right, modify. All right, now you have it. All right, that's a trade set in the market. We kind of anticipated a bit, but let's say it's going to, oh, damn it. Do you see this? The signal's there, the triangle's there. In 2 minutes, you take that goddamn trade. I'm going to take it with my real account. I'm not bullshitting, all right? We do paper trading in here, but I'm definitely not holding to this. So in 2 minutes, remember you apply the strategy. You need to wait for those goddamn 2 minutes. They're really important. If they close like that, they probably will. You need to take that trade, all right? So maybe we're going to have a live trade today. It's rare, but we do have something tradable. As you can see, it comes and goes. So if you trade that, just because you think it's going to maintain, a lot and a shit ton of things can happen in 2 minutes. So please wait for the actual strategy's rules to be met. I mean, trading and entering the trade in here or in here doesn't make a really big difference. It is a difference, but it isn't that big. And crossing and bending the rules just because you think the signal will maintain to the candle close, believe me, if you bend those rules, you're just destroying the entire strategy's advantage. So you don't do that, all right? Don't bend the goddamn rules. If you have the signal by the close but not the triangle, you don't trade unless you're an aggressive trader. You're going to wait for this goddamn triangle to show up. Remember, it is absolutely necessary in ranging context. You need the freaking fucking triangle. All right, that being said, I hope you guys have been learning quite something today. I mean, in terms of applying the strategy on an intraday basis, I think that's definitely the core information you absolutely need to know.